Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Riiv to receive the top 10 stocks to buy right now. Oil prices have been all over the place over the last 3 years, and the last week has been extremely volatile, with prices going up 5% or down 5% in any given day. Now, this is something that impacts everyone's pocketbook, so it's important to understand what's going on in the oil markets. Today, I'm going to break down the important factors to understand in oil today, including some recent news from OPEC, give you 2 investment ideas, and 1 stock that I think you should absolutely avoid. Let's get to it. Oil prices have really spiked recently, but to understand why, we have to go back to the pandemic. There was an unprecedented drop in demand almost overnight, and that had a huge impact on both the supply and demand for oil around the world. You can see in this chart here that demand dropped off a cliff almost overnight. That meant that prices actually went negative for a short period of time in 2020. Producers stopped drilling and even shut some wells at that point in time. That really brought supply down, and there's nowhere to put supply if you're producing supply and all of the inventory is filled. So oil producers were really in a tough position early in the pandemic, trying to match supply with this unprecedented drop in demand. But things actually normalized over the next 6 months to a year, and that put the market in a really interesting position because demand spiked as people went back to work and went back to doing more normal things, and supply had a much harder time keeping up. There's just simply a big lag from when you start drilling a well and when you start actually producing oil. That dynamic, along with Russia's invasion of Ukraine, is what caused oil to spike over $120 per barrel early in 2022. But the dynamic is starting to shift because we're starting to see the economy slow. There's worries that there's going to be a global recession. That would impact the demand side of the supply-demand balance in the oil markets, and that's one reason that prices have come back over the last 6 months or so. On the supply side, we're seeing that companies are drilling more and more for oil. You can see in this chart here that oil rigs in the U.S. continue to climb steadily over time, and oil production is going up as a result. So that's why we're seeing some downward price pressure in oil markets, and I will get to why the market actually thinks that will continue for the next few years in just a second. Now, why did the price of oil spike on Tuesday? That's because there was rumors that OPEC could reduce their supply by about 1 million barrels per day. Reports early on Wednesday from Bloomberg, and then here's another article from Reuters, is that OPEC could reduce production by 2 million barrels per day. This is about the amount that the oil markets were oversupplied in that 2014 range, when oil really spiked to well over $100 per barrel, and then dropped really rapidly to about $40 per barrel. So it doesn't take a big move in production on a global basis for there to be a huge price impact. Now, OPEC has a long history of not actually hitting its quotas, especially as prices go up, because countries want to maximize the amount of revenue that they have coming in. So we'll see what the actual numbers are, but OPEC really seems to be talking a big game right now. One thing that I do think is interesting is this is the oil futures figures from the CME group, and you can see that we are still in what's called backwardation. That means that the future price of oil is lower than the current price of oil as measured by the spot market, which is the next futures contract to settle. That right now is November 2022 at $87.30. But if we go out to the end of 2023, you can see that prices declined to about $75 per barrel. This continues over time all the way into 2024, $69 per barrel, and 2025, $64.50 per barrel. This is actually pretty strange in the oil markets. Typically, oil is in what's called contango. That's when the future price of oil is higher than the current price of oil. But we're backwards right now, which is why this is called backwardation. What the market seems to be thinking is going to happen is that producers will continue to produce more oil, but demand may not keep up. That's as we move to things like electric vehicles and potentially people buying more efficient vehicles because the price of oil is very high. So this is something to keep an eye on if you want to keep on oil markets, is not just what is the spot market doing, what's that number that people are reporting on a day-to-day basis, but what does the futures market look like? Because if it stays in backwardation, it indicates that traders think that the price of oil is going to decline over time and not go up. What I think we know for certain is that there's going to be a lot of volatility in the oil markets, especially if OPEC does go through with a 2 million barrel per day cut. That actually could leave opportunities for US producers. That's why there's a couple of companies I'm intrigued by right now. Phillips 66 is a refiner who makes money as long as people are consuming oil, no matter the price. So that's a stock that I think is really intriguing right now. Another one is ExxonMobil. Not the most exciting name in the oil business, but it's an integrated super major. They know how to make money off of their scale. And we have seen in recent years that as they have cut back on capital spending and oil prices have remained high, they have just become flush with cash. That's become a really great cash flow business. And as long as our people are using oil, this is going to be the kind of company that's going to be able to either return money through the form of dividends or buying back shares. But I think they're both in a really good position right now. One stock that I do want you to be aware of that I would absolutely not buy and hold is US Oil Fund. So the ticker symbol is USO. This is a fund that buys oil futures. And the problem with this fund is they're not able to track the spot market because they're actually buying futures. The spot market is not one single thing. It's actually a rolling futures contract. So they will buy oil futures months into the future, and then they have to sell those futures as it gets closer to settlement because they don't want to actually take oil themselves. Over time, what this does is destroys value of the stock in the ETF itself. You can see in this chart, USO does not track the spot market of oil. It loses value over time. If you are a buy and hold investor, this is not the kind of stock that you want to buy and hold. This stock will theoretically track the daily price movements of oil, but absolutely does not track the price of oil over a long period of time. So please be aware of that. If you have thoughts on the oil market today, please leave comments below, hit that like button, and be sure to subscribe to the Riiv Project. I will see you here next time.